Hello and welcome back to this week's episode of Closed by Mo. My name is Mohammed. I'm hopefully your favorite YouTube host on most things real estate. I'm also a real estate investor and a broker based out of New York City. In this week's episode, we're going to talk about a very special type of seller financing, basically called a wraparound mortgage. Now, I had to do a little bit of studying and education on exactly what a wraparound mortgage is. I also have a blog post about it, which I'll post in the description below. But without further ado, let's jump right into exactly what wraparound mortgages are and what are the advantages and disadvantages of them. Let's go. Now, a wraparound mortgage is sometimes referred to as an all-inclusive mortgage, or a wrap loan is basically when the seller is financing the purchase of the buyer for the home that the seller currently owns and is paying a mortgage on. In other words, the seller basically extends credit to the buyer, who is in turn making a payment to the seller for the mortgage payment of the purchase price of the home. However, the seller still has a note on the original property, which the seller is then making the payment to. Basically, the new mortgage that the buyer has, wraps around the property and all of its inclusive debt, any of the mortgages that already exist on the property itself. It doesn't mean that the mortgage that the seller has transfers over to the buyer or anything like that. No, the buyer has a loan on the property that's being financed by the seller that includes the purchase price and the loan balance, or at least the seller is going to be continuing to make the payments on the loan balance that the seller still has. Now, how does it exactly work per se? So for example, the seller has their existing mortgage on the property that exists, right? The buyer will then make an agreement with the seller and say, hey, look, I want to buy this property. I don't have the funds for it. Will you be able to finance this transaction for me, Mr. or Mrs. Seller? The seller will say, yes, of course, let's do a wraparound mortgage. In this particular case, the seller will still retain that original mortgage that they have on the property itself, and the new mortgage will basically wrap around that entire transaction, meaning in this particular case, the buyer is going to be making payments to the seller directly for that wraparound mortgage, which includes the purchase price of the property, which under it obviously has a loan balance, and the seller is then going to be making their continuous payments to that mortgage that they already have on the property itself. The profit here for the seller is obviously the fact that the mortgage payment that they'll receive from the buyer is going to be higher than what their payments are going to be. So indirectly, they're basically making a profit every single month or every single term that the buyer is going to be paying that mortgage payment to the seller directly. Now, in terms of why this actually happens and why this might be attractive, just like any other seller financing route, the only reason it's mainly attractive for buyers is because buyers, or a certain category of buyers, might not have the credit needed to be able to go to a bank and say, hey, Mr. or Mrs. Banker, I'd like to take out a conventional mortgage or an FHA mortgage to be able to purchase this property. So it might be for a variety of reasons. Maybe financial constraints, credit constraints are usually the primary reason. Another advantage to why this might happen, or why, which scenario this could possibly be in, is the fact that the seller is obviously going to be charging a higher interest rate to the buyers than a traditional bank would. So if the buyers were able to be bankable, meaning they were able to get a conventional mortgage, that mortgage rate, that conventional rate, would have been lower than the wraparound mortgage rate that the seller is going to be financing, because obviously the seller is taking on more risk, and the seller has to make a profit off of that that risk assessment overall. Another advantage on why this happens, or another factor of why seller financing like a wraparound mortgages happen, the seller might be interested in making sure that they continue to receive some cash flow from the property, right? Because remember, the seller still has that mortgage that they're paying, so they're going to be having a cash outflow every single month. And if they're able to do a wraparound financing for a particular buyer who might, let's say, be financially challenged or credit challenged, then in this case, the buyer is paying the mortgage, the wraparound mortgage, to the seller, and the seller is then pocketing that difference of that new payment that they're receiving versus the mortgage payment that they're making on their existing mortgage. Another advantage, obviously, of doing any kind of seller financing is that it'll facilitate a sale much faster. So in this particular case, because there's no banks involved and the seller is the bank, the seller might have his or her own criteria on how to qualify the buyers. So if they feel like the buyer has enough cash in their bank account or has some form of reasonable income coming in, regardless of what kind of income stream that is, that might be something that the seller is okay with, indirectly basically making sure that the property closes faster, because that's not something that a bank may be comfortable with. Of course, another advantage of why something like this would happen is very similar to any other kind of seller financing option, is the fact that you have more room to be flexible with the overall term as well as the negotiation on both sides. So things that a buyer would not have been able to negotiate with, let's say if he or she was going through a traditional purchase, they're able to negotiate now. For example, balloon payments, interest only terms, how long the note will be held for, how long what's the amortization period versus the hold rate. For example, are they going to be calculating their payments off of a 30-year amortization, but they have a balloon payment in 10 years, so they have to have some time to be able to go and get a conventional bank to come and be able to finance the entire transaction, so then they can then pay off the seller and then have a traditional bank note. These are all things that come into play when you're looking at any kind of seller financing, let alone a wraparound mortgage. With that, guys, I hope you definitely enjoyed this video because I had a lot of fun making it, and I definitely learned a lot more about wraparound mortgages too. I'll see you guys next week. Bye-bye.